When it comes to commercial real estate, there are two little acronyms that can mean the difference between a cash cow property and a total financial disaster. OpEx and CapEx. And trust me, understanding them isn't just boring accounting stuff, it is literally the key to figuring out what a property is truly worth. So today, let's break down this billion-dollar difference.
Everything we're about to talk about really just boils down to this one simple but super powerful idea. Think of this as our North Star for the next few minutes. OpEx is all about keeping things running. CapEx is about making things better. It's that simple. Let's keep that in mind as we dive in.
All right, let's get into it. At its heart, this is really a story about two totally different kinds of spending. Each one has its own rule book and, as you'll see, massive implications for a property's bottom line. So, let's break this down side by side. On one hand, you've got your operating expenses, or OpEx. Think of these as the regular, predictable costs, the stuff that happens over and over. They hit your income statement right away, and their whole job is just to maintain the property as it is. Now, capital expenditures, or CapEx, that's a whole different beast. These are the big, rare, one-off investments. They're capitalized, which means they go on the balance sheet as an asset, and their job is to improve the property.
So what does OpEx actually look like in the real world? Well, it's all the day-to-day stuff you'd expect. It's paying the property taxes, the insurance bill, keeping the lights and water on. It's the cleaning crew, and it's fixing a small leaky faucet. These are simply the costs of doing business.
Now compare that to CapEx. We're in the big leagues now. We're not talking about just patching a tiny leak in the roof. We are talking about replacing the entire roof. We're not just getting the AC serviced, we are installing a brand new top-of-the-line HVAC system. These are major, long-term investments that are meant to seriously boost the property's value.
But, it's not always that clean. It's not always black and white. There's this tricky gray area where the line between a simple repair and a major improvement can get really, really blurry.
And this right here is the classic example. You patch a small leak, that's a routine repair, that's OpEx, easy. But a full roof replacement that's going to last for 20 years, that is a huge upgrade, and that's CapEx. It all comes down to the scale and the intent of the project. But how do you really decide what's what? Well, lucky for us, the IRS actually gives us a little framework to help figure this out. It's called the BAR test, and it's pretty simple. If your expense checks any one of these three boxes, the IRS is going to say it's CapEx.
So what do these actually mean? A betterment is pretty much what it sounds like. You're making something better, like swapping out old vinyl floors for beautiful new hardwood. An adaptation is when you change what the space is used for, like turning an old factory into cool new apartments. And a restoration is when you take a building that's in really bad shape and bring it back to life. If your spending does any of that, congratulations, it's CapEx.
Okay, so now we get to why this all matters so much. This isn't just a paperwork headache. Getting this wrong has a huge impact on your cash flow, your taxes, and, at the end of the day, what the building is actually worth.
And just look at this number. This shows you the brutal, cold, hard math of commercial real estate. If your operating costs go up by just $100,000 a year, at a pretty standard 6% cap rate, the value of your property can drop by almost $1.7 million. It's insane, right? And it's because investors value properties based on their net income.
So here's the absolute key takeaway. OpEx is what we call an above-the-line expense. It comes directly out of your revenue, and it crushes your net operating income, your NOI, which is the metric everyone uses to value a property. CapEx, on the other hand, is handled below the line. Yeah, it still costs you cash, but it doesn't hit that all-important NOI number directly.
And as you can probably guess, this whole distinction creates a classic tug-of-war between landlords and tenants. See, in a lot of leases, landlords can pass on those operating costs, the OpEx, directly to the tenants. But CapEx, those big improvements? Nope. That's almost always on the landlord's dime. So you can see why both sides watch how every single penny is classified.
And this is where the lease agreement really spells it all out. If you have a triple net lease, what they call an NNN lease, the tenant is on the hook for pretty much all the OpEx. But if it's a full-service gross lease, the landlord pays for everything. It's so critical to know exactly what kind of lease you're dealing with.
All right, so now that we know the stakes, how do the really smart investors play this game and win? Well, it really just comes down to following a few key best practices, and just as importantly, avoiding some really common and really expensive mistakes. The pros, they're never surprised. They have a 5 to 10-year forecast for their big CapEx projects. It's like a roadmap for the building's future. They document every single decision. They do regular checkups on the property's health. And maybe most importantly, They spend their CapEx dollars on the projects that are going to give them the best bang for their buck.
Okay, mistake number 1, and it's a big one. Not saving up for a rainy day. If you don't set aside cash for those big-ticket items, that new roof, that new HVAC system, you are setting yourself up for a cash flow emergency that can completely blow up your entire investment.
Now this next one is super tempting. You misclassify a regular operating cost as a capital expense. Why? Well, it makes your net operating income look way better than it actually is, which makes the property look more valuable. It's a short-term trick, but it can get you into some serious hot water with the IRS later on.
Then last but not least, a classic rookie mistake. When you're looking at a new deal, it's so easy to get fixated on that beautiful NOI number and just kind of forget about all the big CapEx checks you're going to have to write in the future. It makes your returns look amazing on paper, but it's a fantasy that vanishes the second that bill for the new parking lot shows up.
So, I'll leave you with this question. The next time you walk past a big commercial building, what are you going to see? Are you just going to see the costs of keeping it running today? Or are you going to see the strategic investments that are building its value for tomorrow? Because the difference between those two ways of seeing things, well, that's everything.